All right, for this next lecture, we're going to be going over some inventory or one inventory estimation technique called the gross profit method. And this one should be pretty short, and then we'll have a longer one. We talk about the retail inventory method. That'll be a longer video. So let's kind of jump into the gross profit method. And so, like, when do we use this, and how does it work? And so, sometimes companies might find it, either difficult or impractical to do a physical count of its inventory. And so, whenever that situation arises, they might use the gross profit method. And so, there's several times where that might be the case. And at first, it might seem like, okay, why can't they do a physical count? But hopefully, these examples kind of show you where, actually sometimes it's not that easy. One, obviously, if inventory gets lost, stolen, or destroyed, it's very difficult to do a count of inventory that was lost, stolen, or destroyed. And so you could use this method to kind of estimate what might have been stolen. The other thing too, and this is really kind of the big one, is that for a lot of companies, let's say you're doing a monthly, quarterly, or annual financial report, uh, it might not make sense for you to do a physical count. It just might be one of those, hey, listen, I operate my business. I'm not spending time to do a physical count, but I need to produce financial reports. And so that's very, very common, especially in situations where you're already using inventory cost flow assumptions. Just doing a physical count every month just doesn't make sense. Imagine Walmart counting its inventory. Now they obviously track their inventory closely, but imagine a company that size that, it just would be very impractical. And actually, there's a personal example of this. I was working with like a luxury watch company, and they do their financial statements just every quarter. And the reason why is because that's when they do a physical count. So they'll do a physical count of their inventory at the end of each quarter, and that's when they figure out ending inventory, cost of goods sold, all that kind of stuff. Well, in this particular case, they were trying to do, a transaction with an external party. And the external party said, hey, I want monthly financials. Well, obviously that's kind of a problem because you can't produce monthly financials when cost of goods sold is kind of their major thing and you're not doing a physical count. And so if we needed to, if we were forced to do monthly financials, we would have to do estimates. That'd be the only way that they could do it. And we probably would use something like their gross profit method to provide that information. And so, again, there are very practical reasons why you might do this. That's just one. The other thing you might, as an auditor someday, sort of want to test, like, is the reasonableness of our count, or did we maybe miss something? And so it's just sort of a sanity check. And then obviously, if we're doing some forward looking, right, if we're projecting revenues and growth and all that kind of stuff, you may want to also project forward, well, how much inventory am I going to have on hand? How much is going to be my cost of goods sold going forward? And so you kind of want to project the balance sheet in addition to just the P&L. And so you might use this method to do that. All right, so kind of go back to a framework that we've been using a little bit, especially if we kind of focus on the theoretical way we should go about looking at financial statements. And we kind of have been working somewhere looking about this, where we have a beginning inventory, which is either some prior accounting record or a physical count or whatever it is. And then of course you are tracking your purchases, you're putting those into your accounting system. And together those give us our goods available for sale. We know this. All right. And what we had been doing, either directly or indirectly, is we had been doing a count of our ending inventory and then assigning costs or whatever we were doing. But we would calculate our ending inventory, and from that we would derive our cost of goods sold. And this is consistent with the conceptual framework where changes in the balance sheet drive the income statement. So this was the approach that we were using. But the issue is, what if we don't know the ending inventory? In other words, we can't calculate the inventory in order to infer cost of goods sold. And so basically at that point, if you're using the gross profit method, you are going to end up working from the other direction. So again, just like we had before, we do have a beginning inventory amount. We have our purchases. We've been tracking that, which means we have goods available for sale. So we still have that information. But at this point, we don't have a physical count of ending inventory. And so with the gross profit method, instead what we do is we estimate cost of goods sold and then back into an estimate of our ending inventory. Again, we don't have a physical count. So these are estimates, but we're going to estimate cost of goods sold and back into inventory. And again, we might be doing this to create a monthly report or a quarterly report. And eventually you're going to do a physical count and everything's going to get reconciled. But for those interim reports, you're going to use this estimate. And so again, you're going to estimate this information, usually based on historical performance, and then we're going to back into our ending inventory. And so let's walk through an example. So in this example, they have inventory of $15,000. They have purchases of 85,000. And then we have some other information. Basically, they're not going to do a physical count at the end of the quarter. Normally speaking, their gross profit margin is about 48%. And one thing to think about that number is if the gross profit margin is 48%, the question you should be saying is, okay, what does it tell us about cost of goods sold? And hopefully you concluded, or you might want to pause and think about it, but hopefully you conclude that cost of goods sold as a percent of sales is 1 minus our gross profit percentage. So our gross profit margin is 48%. That means cost of goods sold is 52% of our sales. And we're given our sales for the quarter of $175,000. All right, so how would we implement this method? All right, so again, we have our beginning inventory, we have our net purchases, which tells us that we get our goods available for sale of $100,000. And again, to be clear, what we do is we estimate our cost of goods sold. And so in this case, we're going to use this information, the 48% gross profit margin and the total sales of 175. And we're going to estimate our cost of goods sold as again 1 minus 0.48, which is 52% of 175,000 is $91,000. So our estimated cost of goods sold is 91,000 and therefore our estimated ending inventory must be 9,000. Again, it's still true that cost of goods sold and ending inventory must get us goods available for sale. So 100,000 minus 91,000 gives us 9,000. Again, very short method, hopefully very easy, and hopefully not too difficult. So we're going to stop there, and then we're going to pick up the retail method next.